Good afternoon, everyone, and thanks very much for the invitation. It's always nice to have an excuse to come to Adelaide, especially on days like today. When I was here last time earlier this year, speaking at the CEDA Economic and Political Outlook, I mentioned that economists' consumption of champagne had been running above average, reflecting our pretty solid economy and expectations that was going to continue. Well, 6 months later, I think a lot of the key themes we talked about then are still intact, but we have downgraded our champagne from that imported French stuff to the domestic variety, and that does reflect some of the increasing risks that are building on the global front. And of course, the most visible of those risks right now is the possibility of a trade war and the damage they could do to the global economy and to everyone involved in it. And I guess we are going to slap tariffs on everything. That imported French champagne is going to be too expensive anyway. Now, as I said, most of the key economic themes for Australia back in February are still playing out in the way we expected. In fact, I've summarised them on this table here. So when I think about what I said then and what's happening right now, well, despite those rising global concerns, the fact is the global economy is still growing. We're probably going to see a set of US growth numbers later this week that show the US economy in particular is very strong at the moment. If I turn my eye to Australia, what stands out is still the same things again. As I said, it is getting easier for the economy to grow because the last of those commodity-related headwinds that have been holding us back over the last few years have come to an end, and in fact, in some cases, are now positive. So we are starting to see, for example, some new mining projects come through, which I would say 6 months ago nobody thought was very likely at all. When I look at what's going to be driving growth in Australia, it's a lot of things that look to be pretty much guaranteed. So we are going to see a big increase in LNG exports come through as all those big gas plants are turned on and ramp up. There is an infrastructure boom going on pretty much everywhere at the moment, and rising Asian incomes are driving booms in things like tourism and education as well. What I'd also say is some of the growth risks that we did worry about earlier in the year now look less likely. So big downturn in residential construction, which could be a big drag on the economy, now looks less likely. And businesses finally lifting capex after a long time when not much was happening on that front. We're still worried, though, of course, about the very high levels of household debt in Australia at a time of weak income growth. Inflation, well, it remains low, as we saw on the figures yesterday, and certainly no trigger there for any change in interest rates anytime soon. That said, we still think the next move in interest rates will be up, but it's certainly not going to be this year, and it seems to be receding further and further into next year as well. You can see these kind of positive themes, if you like, playing out in the numbers, and this chart here just gives you a bit of a snapshot of the key economic indicators for Australia. So the red line, economic growth, running a bit over 3% at the moment. So it's actually above the 2.75% that we think of as normal growth for Australia. So pretty good outcome from that perspective. The green line there, the unemployment rate, well, it's slowly moving down. 5.4% right now, getting close to the 5% that we tend to think of as full employment for Australia. And as I mentioned, inflation bumping around about the bottom end of the Reserve Bank's 2 to 3% target range. So what possibly could go wrong? Well, as I suggested at the start, the most obvious threat to worry about right now is the risk of a trade war, and that's pretty much what I'm going to talk about today. Now, the first shots in that trade war were fired by the US on the 6th of July at midnight, but the origins of this trade war, I think we can trace back a lot further than that. And again, the people who've been to CEDA functions before might recall this chart that I have shown. It's called the elephant curve, and if you can't quite see why, that's a hint. But the reason that it's worth looking at is it gives you an idea about what's been happening with incomes around the world. The way to read that chart is the further to the left you are, the poorer you are, the further to the right, the richer you are, and then the vertical axis just tells you how much has your income increased over the 20 years to 2008. Now, most groups went ahead quite well over that period, but you can see there's a group there that's kind of in the 80th to 95th percentile that really went nowhere, went backwards at some part of the curve there. Who sits in that part of the curve? Well, it's mainly the middle income populations in the advanced economies. So what you have in those economies is a lot of people who feel like they haven't really seen any benefit at all in all of the economic reforms and so on. The people like me, like politicians and so on, are forever pushing and telling everybody is in fact a good thing. They don't believe it, they can't see it personally. So this sort of strong vein of disillusionment has been building up around the world on the back of that development over the last decade or so. And it certainly reflects, I think, about how the gains have been shared or not shared. And it's very interesting to hear the Governor of the Reserve Bank saying in recent times that he's a bit concerned about weak income growth because it's diminishing our sense of shared prosperity. And so you've got a kind of whole social dynamic that's in there over and above the kind of pure economics that people like me focus on over time. It's not just the income story. There are other factors in play here, and some of those kind of non-economic factors that are adding to the kind of anti-establishment push are things like concerns about migration. Now, there is, believe it or not, an organisation that measures how scared people are about immigration, and you can see the results for the major economies on the chart on the left-hand side here, and you can see that kind of European migration crisis in 2015, 2016, the big impact it had on that kind of part of the whole perception story. Now, you add that into the general mix, and what you get is a situation where global trust in government has declined pretty much everywhere, and you can see on the chart on the right-hand side there a measure of that trust and the sorts of very low levels that it's running at right now. So against that, well, unexpected political outcomes are less unexpected, if you like, and what you've seen in particular is a rise of populism, populist leaders and parties and the like coming to the fore. And when you start digging into this in a bit more detail, the experts tell us that there's a couple of key characteristics about populist leaders, and that is they like to appeal to the people who've been badly treated by the elites. There's a desire to shock the establishment and prove the credentials as one of the people, and they like to use or manufacture crises to drive the message home. And I'm sure if you run through that checklist, you can probably think of a few people who tick those boxes. So certainly, I think you can see things like the Brexit vote as an outcome of this sort of process, and you can also, of course, see the advent of President Trump in the same mix. And in fact, when we look at the numbers here, this chart shows you the share of the vote going to populist parties over the last 100 years or so, and the latest figures there on the right-hand side, well, clearly very high share, reflecting how all these forces are coming together. The other point that stands out about that chart, I think, is that that kind of populism measure, if you like, is at the same levels as we saw back in the 1930s. I don't want to suggest that the story ends the same way it did back in the 1930s, but it clearly tells you about the risks of things like rising nationalism and protectionism, which feed straight into this trade war idea that we're talking about today. If you move on from there, well, one of the things that economists like to do, and that is get their forecasts right. If you're a politician, though, you want to get elected and you want to get re-elected. And it's fair to say, I think President Trump has polarised opinions in the US and elsewhere. And one indication of just how polarising it's been is the chart on the right-hand side here. It shows you something called the Partisan Conflict Index. And what it actually measures is the degree of disagreement, if you like, between the president, between the administration and with Congress. And the higher that line is, the greater the degree of disagreement is. And you can see quite clearly how the trend there, the levels there have shifted in recent times. I should also point out that this increase actually occurred before President Trump took over, so we can't sheet all of the blame to him, but he's certainly taken it to new levels. But one of the end results of this conflict is that President Trump's approval rating has dropped a long way since he was elected. And the chart on the left-hand side here, the bottom axis looks at presidential approval ratings at this particular point in the electoral cycle for President Trump and, of course, other presidents over time. And the vertical axis there then just kind of translates into what does that approval rating translate to into loss of seats in Congress. Well, on current ratings, when these midterm elections in the US come around in November this year, potentially President Trump is looking at losing a lot of supporters in Congress. Of course, the prospect of losing seats is something that concentrates political minds for very obvious reasons. And it's reinforced the idea, I think, that you need kind of sort of a message to sell into the election campaign. And if you think about that, well, the tax cuts that went through in the US late last year, well, they went through much more easily, quickly than most people expected at the time. And I think it kind of reflects this focus on the elections coming up in the US. And of course also means that it's now easier to get other parts of President Trump's agenda through, and the trade story is clearly one of the focuses coming through there right now. So a lot of this, I think, has a kind of a political dynamic to it, not surprisingly. And what I think stands out when you go into kind of a deeper dive into what's actually happening on the trade story right now, it's very clear that, again, that politics is driving a lot of the decisions. And in some ways, there's a very high degree of, I think, clever politics in play. The clever bit relates to the choice of targets here. So what is the kind of signature item that the US has chosen in this trade war? Well, it's steel, essentially. What's the signature item that China's chosen in retaliation? It's soybeans. So these are the kind of two test cases, if you like, to look at when you're thinking about how this story plays out. Where the politics come through, I think, is on this chart here. What it shows you is where are the steel plants in the US, and the green bars there, they're all basically in the states that voted for President Trump. So he's picked an industry, a sector, if you like, that plays very closely to his support base. We now think about, as I say, what China has done in retaliation with soybeans, and ask the question, well, where are soybeans grown in the US? This chart here gives you the answer. You can kind of see the states down the left-hand side there. But again, what stands out from those green bars is that most soybeans are grown in states that vote for President Trump. So again, the Chinese have been clever in a sense that picking a kind of a pain point for President Trump from that perspective. And I mean, you can extend it out from there. So Europe, for example, in their responses, well, they've chosen to focus on Harley Davidsons and bourbon. That sounds a bit of an odd mix in many ways until you realise that Harley production is based in the home state of the Republican Speaker, Paul Ryan, and that's Wisconsin. Where does bourbon come from? Well, it comes from Kentucky, and that's the home state of the Republican Senate leader, Mitch McConnell. So again, very clearly, the sort of targets for this trade war story have been chosen very carefully, it seems. So it's not a kind of full-on shooting war. It's very sort of selected targeting going on at the moment. And if it is politics, then I think the most likely outcome is that you find a political solution to this. And if that's true, then the whole idea of a trade war, I think you keep it in the risk basket. This is something to watch. It is something to worry about. But we're not yet at the point where you're wanting to incorporate it into your sort of central forecast for the next few years. And again, I think really just to emphasise the point here, if you were really sort of concerned about trading arrangements and protecting your home economy, if you're the US, would you in fact be choosing China? Well, this chart here shows you for all the US states, who are their major trading partners. Well, clearly if you were really worried about the story, you'd be targeting Canada and Mexico. There's very few states that actually have China as their number one trading partner. And so if you're concerned about the economics, it's more about the responses from Mexico and Canada that would have potentially the bigger negative impact on the US economy because of this sort of trade dispersion that you can see on this chart. And what have been the responses from Canada and Mexico? Well, the tariffs that Canada have put on are worth about $13 billion, and the tariffs that Mexico has put on are worth about $3 billion. Now, these numbers are just meaningless in the relative to the size of the US economy. So the bits of the story that could do the real economic damage to the US are just such a tiny part of the total that again, you wouldn't be particularly worried about the growth implications coming through here. They won't shift the economic dial. But if you bring it back to the two main protagonists, the US and China, well, they are both in a sense 800-pound gorillas. But their trade diet is actually pretty limited, again, when you look at the numbers. The chart on the right-hand side here What it shows you is the green bars there for China, red bars for US, the size of their economies, that's the bigger bar, and the smaller bars, if you can make them out there, are the trade between the two countries. And the reality here is that you could close down that two-way trade tomorrow, and it's just not a big enough part of the overall economic story, or relative to the size of those two economies, to really do a lot of economic damage. I think the bigger risk to the story here is more about what happens to business consumer confidence in this environment. If you see these concerns about trade wars having a negative impact there, then you start to see businesses, for example, cutting back their capex, cutting back their employment and so on, and you can then kind of magnify the impact across the broader economy. Now, the data so far, at least, it's hard to see any impact really coming through in terms of business and consumer confidence, but it's clearly on the radar. The chart on the right-hand side there, which shows you some of the things you can do with technology these days. There is a US company that records all company CEO phone calls when they update investors and so on about what's happening with their particular company. And what it tracks in this case is the number of times the words that tariff and trade war get mentioned in those phone calls. And you can see the big spike up at the end of the chart there. So clearly trade war, tariffs, it's on the radar. But we haven't seen it flown through to those confidence type measures yet. But that's the area that we'll be watching most closely when we're thinking about the potential risks to the global economy. What you can see, though, more of an impact coming through, I think, is in financial markets. They do tend to respond these days to the various news flows about trade wars and what is happening. And just a couple of examples on the set of charts here. Again, just to prove that grey-haired economists are right up with the technology as well, the chart on the left-hand side here, the black line, it shows you what's trending on Google in terms of people looking for stories about the trade war. And you can see how that's moved up and down as the news flow has varied. But what you're also seeing is that having an impact on various measures of financial market risk. So the green line there, something that's called the VIX index, well, it's kind of a global fear gauge is the way people tend to think about it. And you can see now that kind of spikes and concerns about trade wars is driving to lifts in volatility. It's something that's going to create a more volatile financial market potentially for all of us from here. And markets are also, I think, pricing in for some of the trade war negatives as well when you look at the chart on the right-hand side. It's looking at global share prices, and what it shows you is the ratio of big company share prices to small companies. As that line goes down, what it means is that the market's pricing big companies less favourably than small companies. And the idea is it's the big companies are the ones who are involved in global trade, so they'll be the ones that get hurt in a trade war. Smaller companies, well, they're more tied into the domestic story, and so kind of got a lot more insulation or protection against the trade war story. So we are seeing markets pricing in some of this, even if we don't think it's really going to play out that way. There's a few things economists can say about trade wars, and that is every trade war, prices rise. It's the little guys that get hurt, and nobody wins. And you can see this again pretty clearly if we go back to that earlier focus on steel and soybeans. So one of the kind of justifications that's being used for putting tariffs on steel is in the US in its desire to increase domestic production. They want to get steel capacity usage in the US back up over 80%. Now, if you look at that chart on the left, that would actually be pushing steel capacity use in the US well above its long-run average, well above where it's now. And you're trying to do that at a time when the economy there is very strong and at full employment. So the most likely outcome is you won't get an increase in production, you'll just get an increase in price coming through. Likewise, if you think about soybeans, the chart on the right just shows you who buys soybeans, mainly China. Who produces them? Very big producer is the US. And the reality is there aren't enough soybeans outside the US to satisfy Chinese demand. They're going to have to keep buying soybeans from the US, and they're going to be paying a higher price for that. So again, no change in the dynamics, but just higher prices being paid. Likewise, we think about the little guys. Well, I said earlier on the trade story is not really big enough to damage the US or China, but all those people sitting between those two players who are big participants in global production chains, That's, I think, where the real potential risk for damage lies. And the chart here, again, kind of makes the point. The way to read that, the bottom axis there shows you how much of your trade goes to the US and China. The vertical axis just shows you how tied in you are to global production chains. And I've kind of circled there the countries that are exposed in both directions. You'll see a lot of those are in fact actually the countries in Asia, at the ASEAN nations in particular. That's where to look for the economic damage. Of course, those countries are actually quite important for Australia as well. So maybe the US and China aren't hurt too much, but these guys sitting between the two of them potentially will be. Nobody wins. The final point there. Well, we know from the work that the Productivity Commission has done in Australia that if you were to have a proper trade war, and that means everybody in the world increases their tariffs, then there's only one outcome, and that's a global recession. I produced a very nice 300-page report on this, which I've summarised down to this one chart for you. But what it shows you is the impact on growth for various countries and regions around the world if everybody raised their tariffs by 15%. The answer is it would knock 3% off global GDP growth, so would be a recession, as I say. Global trade would drop by 22%, give you an idea of just how powerful impact it would be on the trade part of the story. And for Australia, though, the kind of first bar on the left-hand side there would knock about 1% off growth here. Now, that'd be painful, but it wouldn't be as painful as it is for most of those other countries and regions that you can see. Now, why is that? Well, Australia's actually, we think, got a degree of protection if there is a full-on trade war, and it comes through from a number of areas. I mentioned that those countries that are in global production chains get hurt. Well, Australia is not actually all that plugged into that global production chain story. Outside of mining, the participation is actually pretty low, so we've got less exposure there. Reality is the Australian economy has grown for nearly 27 years now, so it tells you we've got a fair amount of resilience to deal with global economic shocks when they come through. Our policymakers could still do something in that particular scenario, so we still could cut interest rates if needed. And of course, the other thing we know is that every time there is a global shock, the first thing that happens is the Australian dollar sinks like a stone. And I've highlighted some of those episodes on this particular chart here. And that flexible currency, if you like, is probably the biggest shock absorber that we have. And it's one of the key reasons that we've actually been able to ride over all these previous global episodes and come out the other side in reasonable shape. Now, I'll stop at that point. I realise I'm standing between everybody and lunch, so it's probably a good place to stop. So overall, we think trade war risk, not reality, and the Australian economy in the background there continues to run along at what we describe as a decent pace of around about 3% over the next year or two. Thank you for your time.